say that I am born 10,000 years ago. And if you think about what I was doing, most likely, I was basically trying to figure out what is the best way to hunt. Now, all of a sudden, I'm doing data science here. I'm looking at loss functions, right? I'd argue that the loss function of the mind is value. We are universal value approximators. Seeing is actually imagining. What you see is actually molded and distorted by your own value system. Data science. So first off, introduction. So my name is Naveen Benny. I'm the founder of this company called Prometei Labs. At Prometei Labs, we're trying to try to create a new age quantitative fund that essentially uses RL-based agents to predict and trade the markets. So the vision is kind of grand, and we've been building it for some time now. And my background is I have like almost 10 years of experience. Actually, not 10, maybe like 12 years of experience training AI models and machine learning models. Around 2015 or so, I realized, deep learning was making a lot of noise. It was beating all the benchmarks. So I kind of moved to deep learning. And then, slowly afterwards, I realized that probably the best way to start off, use my skill set is to actually start building companies. So in 2016 or so, I started building companies. And this is actually my third company. So I've got like an experience. Mostly my technical experience is in the AI side, but I also have some experience building companies in my third company. So anyway, so moving on, my intention here is to, like I said, right, there's going to be a lot of philosophy involved in what I'm saying. I'm like very philosophically oriented. So I hope that you guys will enjoy that part of the presentation. To start off, I think, I want to talk about how infinitely malleable the human soul is, right? Like if you go back like 10,000 years ago, say that I am born 10,000 years ago. And if you think about what I was doing, most likely, I was basically trying to figure out what is the best way to hunt, right? Maybe I was trying to figure out, okay, how can I make a spear that really flies? In fact, there was, this picture here is actually of this device that was found in archaeological evidence called the atlatl. Maybe I'm butchering the pronunciation, but it's very fascinating because this little thing could actually fly at like 150 kilometers per hour. And it would go like 100 meters per hour. In fact, humans use this to hunt the woolly mammoth, right? It's really a miracle of human ingenuity, if you think about it, that someone who's so physically, a species that's so physically not very impressive could take down something like a woolly mammoth, right? Like the scale of the woolly mammoth, right? And come down like say 5,000 years later, I'd probably be concerned about, how to grow crops, right? The movement of the sun, the movement of seasons, stuff like that, right? And then you come back later, I'm probably concerned about, okay, how do I build a city? How do I do plumbing, stuff like that? And now all of a sudden, I'm doing data science here. I'm looking at loss functions, right? So if 10,000 BC, Naveen could look at me, it would probably look like a god to that being, right? Like this guy who's talking in like a completely new language, talking about numbers in the air, talking about loss functions, building these agents, which are supposed to be intelligent, almost like animals, right? They'll probably think that I'm a god, right? So our evolution from tribals to a god is just phenomenal. And I think about this a lot, and I think it's very singular quality that makes us human, right? There's no other animal that's actually evolved, not just, we have all evolved like genetically, right? We have all evolved. We know about genetic evolution where the survival of the fittest happens, right? But we don't know, we also have mimetic evolution, which is a term that's coined by Richard Dawkins, if you guys are familiar with it, where our ideas itself evolved, right? So that's fascinating, and that's not something other animals do, right? Cats are still cats 10,000 years ago. You see the same cat is the same cat, but the same Naveen is not the same Naveen, right? So that's a singular quality of the human condition, right? So, obviously, if you think about it, it's nothing but just general intelligence, right? So general intelligence is the ability to solve any problem, right? The same machine that I am right now can drive a car, can tie my shoelace, right? But an LLM can't drive a car, or can it tie shoelace, despite, how intelligent it is. So that is why it is not general, right? The intelligence is not general. And that's pretty amazing. And like, if you think about, what is actually, molding this, how does this mimetic evolution really happen? Like, how are our minds really like evolving to, what is it evolving towards? Like, what is the loss function of the mind, right? And I'd argue that the loss function of the mind is value, right? So what do I mean by value? Like, value is anything that's useful, right? 10,000 years ago, what's useful is how do I build a weapon that can fly at 150 kilometers per hour, right? Now it's about, okay, how do I get the loss function of this agent to come down, right? So I would suggest, like, just like neural networks, you can say that neural networks, if you guys are familiar with this term, they're known as universal function approximators, right? So what does that mean? It means that theoretically, if you have a complex enough model, you can actually like model anything, right? Even if you give it like 10,000 pictures of like random noise, no patterns in it, it will by heart it. And that is why, they're called universal function approximators. And just like neural networks are universal function approximators, I'd like to, posit that we are universal value approximators, right? So we look to the future and we try to predict what is the value of something, right? And that's pretty special, right? So in fact, there's this leading body of psychologists. They say that what we see is not really colors and shapes and stuff like that. What we see is value. So if I look at this chair over there, I'm not thinking this chair is black or this is shaped like a chair or anything like that. What I'm thinking is, okay, there's a chair, and what I can do with the chair is I can go sit down, and I have an injury on my left leg. So, I know I can't stand for a long time without my left leg hurting, right? So I feel, when I look at the chair, I feel release, right? Maybe if someone else looks at the chair, they won't feel like that because they don't have that injury, right? So I'm not just predicting the value, I'm not just looking at it and saying that is the value. I'm making a prediction about that value, that if I go and sit down, I will feel relief, right? This value is estimated in the future, right? So that's a very important thing, that value, what we see is value, and we are not just seeing value, but we are estimating value. In some sense, seeing is actually imagining. What you see is actually molded and distorted by your own value system, right? So you see it, and if you think that chair is valuable in your mind, based on your value system, that chair is useful. Otherwise, it's not, right? So that's that's awesome. So what that means is that we are like aligned to value, and we recognize value, we pursue value, and we create value. And that perhaps is the greatest purpose that we as humanity can actually like seek, right? To create value. And that brings me down to a little bit of, where am I? Right. Okay. So coming down to all these, if you think about it, like all of our pursuits are actually exactly that, right? The creation and estimation of value. I would argue that something like religion, which can be a very controversial topic in like today's day and age, but if you take away all the fluff, the bearded guy sitting in heaven, if you take all that away, you could argue that even religion is merely theory of value creation. It's very easy for me to say that if I drop this pen, it's going to fall down, right? But tell me what happens if, like if I eat that piece of cake today and tomorrow and day after tomorrow, what's going to happen in 1 week, 1 year, 10 years, right? I'll probably fall sick, right, if I load myself with carbs, right? So it's very easy for us to estimate the value of the near future, but it's really, really hard to go beyond it. And that's when science starts to become philosophy. And that is where religion is. Perhaps, the idea of karma is very simple, right? It's just, the old version, the ancient version of FAFO. If you guys are familiar with the term, I don't want to elaborate it. Have you guys heard the term FAFO? No? Really? I knew my boy Vihan would know it. So, yeah, exactly. So this is the consequences of your action, right? Like if you cheat today, if you cheat yourself or you cheat others, tomorrow the consequences will come to you, right? It's just that it happens way later. And that is exactly what religion is, right? It's telling you about the value of your actions today, how it will, be tomorrow. And of course, like that leads me to, of course, capitalism. Always wondered why people have such a religious point of view when it comes to capitalism and communism and all that, right? You can see that communists tend to be atheists, right? Where capitalists, like the Western world is capitalists, and because they were predominantly Christian, right? So why is it that there's such a religious aspect to it? But of course, it makes sense now because capitalism is also a theory of value creation, right? All economics is exactly that, right? How do you create value with, the least amount of resources, right? Economically, right? So that is what capitalism is. And if what capitalism has taught us anything is that when humanity is aligned to value, right, we prosper. But you take away the value signal, right? It's just chaos. If you guys don't know history, please go back and read up on communism. And I'm from Kerala, by the way, so, we are, like part of us is communists. But I know there are definitely good aspects of socialism like healthcare and education, and perhaps they have to be, if you ask me. But at the same time, if you actually think about communism and go back to history, you'd find that it is perhaps the most deadliest idea that we have come up with. Just purely in terms of the number of people who have died. Just purely in that. Like Mao Zedong, he started this giant leap forward program where he took away private property from farmers and basically started this collectivization campaign. He got all these farmers together and told them, this is the community's farm, let's farm. What happens? You're taking the value signal, right? Now whatever effort you put in, you're not going to be able to feed your family from that. You're going to feed someone else who's probably not working, right? It's just averaging it out, right? Your incentives are gone. And what happened? There was a widespread famine. It killed 30 or 40 million people. COVID killed what? 5 million people? So 30 or 40 million Chinese people, it's not a joke. It's a large number. And at that point of time, China's population was maybe, I don't know, 300, 400 million, right? So that's 10% of the population. It's massive. And it got so bad that, with value, you take away value, you also taking away the truth, right? People's ability to speak truth, right? That's how authoritarianism and tyranny prospers, right? You take away the truth. So people started saying that, okay, it's because sparrows are coming and eating from the granaries. And they started killing the sparrows. And they killed so many sparrows that at the end of the day, there was like an ecological disaster. And the sparrows were eating the insects. And now the insects, there was like a flood of insects. And the insects started eating the crops and there was more famine. So that's crazy. So that is exactly what happens when you take away the value signal from humans, right? So it's something that you should be very careful about. And it's also be careful about taking away the truth, right? Because value is just manifested in truth. We seek truth because in truth there is value. You act according to the truth, you will get value. You will create value. So if you think about the early origins of capitalism, we'll go back to the Dutch East India Company. So the Dutch East India Company is the first corporation that was ever set up. In fact, it was actually one of the biggest companies ever. Its market cap was around $8 trillion, which is nothing compared to what's Apple's market cap now, 2 trillion. So it was like massive. So the problem with mercantile capitalism was that it was very risky and it was very, very expensive, right? So typically what happens is people fund like a voyage to find new lands, and they get all the people to come together and like basically go on this voyage, which is obviously can last 2 to 3 years. And, it's very risky in terms of there are pirates, there's death, there's disease, right? And, chances are you probably wouldn't even find new land, in which case you lose all of your money. So it's very expensive, very risky. So that is exactly what incentivized them to set up a stock market, which is that instead of, 1 or 2 people who's creating this, why not have like a lot of people who are diversified in their risk and they all get to bet on this voyage. And hopefully, if they lose money, they lose a little bit. The risk is limited. But if they make money, they make a lot more, right? So the early form of, the stock market, the Amsterdam Stock Exchange was started purely for this reason, just to diversify risk. But then there are other questions, other interesting things. Like, for example, it allowed liquidity to people who put in the money, right? So what liquidity means is that if I want to sell my stock today and maybe I had an accident or something, I need some cash, you can go and sell your stock. But then the question of, the fair value of your stock comes to play, right? What is the value of your stock? What is the value of the stock is something that had to be estimated, right? You could do something very simple and say that, okay, the value of one share of the Dutch East India Trading Company is essentially all the assets that it owns. And you take those assets and you divide it up, you minus the liabilities, the ships and the inventory and, all the spices and all that. And you calculate it up and then you'll have a number. But, that's obviously a very, not really a good way, because this is a productive asset, right? You will generate cash flows, right? Every year, maybe you will get some cash returns in terms of the profit generated. So you could do something more sophisticated. Maybe you can calculate the amount of cash and discount it over years and calculate what is the discounted cash flow, right? That's one way to value it and factor that into the stock. That's another way to value it. But then again, that's not good enough, because it could be that they find new lands and, there's more revenue streams and the company grows really fast, right? Or it could be that there's a famine or, there's some disease or, something, there's bad weather or something like that. So there's just an endless possibility of things that can, that is basically used in this calculation of the value of a stock. So what I'm trying to say is that, calculating the value of a stock is really, really hard, right? So that's the challenge with, there's no particular science to calculate the value of the stock. So, we can just look at an example here. So what you see here is, the Twitter price during the acquisition saga. I'm sure a lot of you guys have been following it. I found this quite interesting. So if you see here, what you see here is on Monday, the 4th of April, you can see that, oh, I'm sorry that you can't read it properly, but that's the day in which Musk discloses his stake in Twitter. He owned about 10% of Twitter. And the moment that news came out, you can see that the price jumped from, like 40 odd to like 50 or something like that, right? So that's just basically the market saying that, okay, what is the value of Twitter if a person like Musk, who's a great operator, is in the play, right? And apparently it thinks that it's like 60, 70% valued more, Twitter, right? And then what happens is on 25th of April, Twitter finally accepts his bid to take over the company at $44 billion, which translates to $54 per share, $54.2 per share. So if you take up all the outstanding shares of Twitter and you divide it by 44 billion, that's the number you will get, right? So one interesting thing that you can see the price has gone up on the 25th of April, but it's not really reached 54.2, even though someone is telling you clearly that this is the value of your stock, right? So what is that delta? And then you see, there's obviously the whole saga of him not then backing out of the deal, and then they go into trial, and then finally, on the 28th of October, they decide that, we'll do the deal. And even then on that day, the stock doesn't really reach 54.2, right? It's just a little far away. Is anyone on the, okay, cool. So that's interesting. So what is curious to note here is the fact that despite the 54.2 value, the price never really reached that value, right? It is always tracking close to it, but never exactly at that, even though that is the fair value of the trade. Can anyone take a guess to why that is the case?
Still Musk was gain one.
No, but once the acquisition happens, every shareholder will get $54.2. But somehow that's not the price that the market is trading at. The market is trading slightly below that.
We are expecting some more further bad news somehow.
Absolutely. So that's risk, right? Unless
Musk is paying.
Right, exactly, right? So there's basically an infinite number of possibilities until the paper, the deal is put on paper, right? So what I'm trying to say is that the market is not just valuing the company, but it's also valuing the risk, the probability of this transaction actually going through and your 54.2 hitting your bank, right? So that's very interesting, right? So risk is like a very essential part. And if you guys have heard of options are essentially like how you hedge your risk in the stock market. So just like you have insurance, right? You have insurance where you're willing to pay a certain amount every month just to hedge your risk that tomorrow if you have a deadly disease and you have to spend 50L or something like that, someone else will pay for it. If nothing happens, well and good, you lose your money. That's the price that you pay for risk, right? So that is what insurance is. And options is very similar to that. And that's how, options is sort of like, if you don't, if the stock goes down, if you buy an option, that will give you the privilege to buy that stock at a certain value. So that is what options is. So options is also one way that the stock market, values risk, right? Now, here's another example, which I find mind-blowing, by the way. Have you guys heard of Polymarket, right? Polymarket is a betting market, right? So very similar. And this is the Polymarket, the chart, the odds of Trump winning the election, right? And if you can see on top, you'll see that there was $3.6 billion being put to it. So this is some real money, guys. This is as big as companies, right? So this is some real money. And the interesting thing is that despite all the polls and pundits telling that even close to the election, they were all saying that Kamala Harris is going to win the election, 52%, 53%. But Polymarket is clearly saying, giving Trump a 60% probability of winning, right? And it got $3.6 billion put behind it. Why? How is it that the market is completely different? And there's another interesting part. Polymarket was the first people to actually, it hit a 99% accuracy, obviously 1% risk, but 99% risk, percent accuracy, I think a good 4 or 5 hours before the elections were declared. Before the pollsters came out and said Trump won the election, they already declared the victory. So Polymarket was actually the first people to declare it. Isn't that amazing? How is it that a bunch of people are sitting and betting with their money and they're able to make predictions about the world that experts and pundits are completely missed out, right? So the markets are really, really good at predicting the future, guys. And we'll go through why. So this is CNN about how the market saw something that the polls and pundits didn't. And they'll give you all their gyan and they'll say that they got lucky and all that. That's not the case. At least I like to claim that. So it's the same case with the Biden dropout as well. So even before the, his goof up in the the primary debate, you can see that it was valuing him dropping out at 20%, which like nobody expected him to drop out, right? Like there's no possibility of him dropping out, but they valued at 20%. And obviously here again, it's like way ahead of him dropping out. In fact, I think the markets knew he was dropping out way before he did, if you ask me. So that's fascinating. So the markets are like really, really good at predicting the future. And like, I've always wondered why. And that brings me to this concept, right? Have you guys heard of gradient boosting machines? I'm sure many of you guys have worked with gradient boosting machines. These are like a class of machine learning algorithms. How they work is it's like an amalgamation of multiple models. And each of these models are like very weak classifier. So they're not like very complex or strong classifiers. So it's not like one model to rule them all. What you have is you have one model, you basically make predictions with that. And whatever it gets wrong, you get a new model to add along. And then that kind of makes predictions on where it's getting wrong and so on till you find that all these models combined have a very strong accuracy. Right, this concept is actually known as model ensembles, right? So when I encountered this, this model ensembles, I was like very fascinated, right? Because here I am as a data scientist, working on the perfect model, feeding in the data so beautifully, capping it at -1, making sure everything is good. But then all of a sudden, if you take that same model and you make 10 copies of that, and then you make predictions on that and you take a vote, you'll see that you get like a 2 or 3% increase in accuracy, right? To me, that was like that was very offensive, to be honest, right? Like you're getting a free accuracy boost just by, doing the same thing over and over again, right? So that was very interesting to me. And I always wondered, why is it that when you take the same model, the same weights and the same set of data, and just the initial weights are different, and then you take the votes of all these different models with different starting points, all of a sudden the accuracy is higher. Right? And I always wondered why. And the answer to that is this, right? You guys are familiar with the bias and variance trade-off. It's like the bread and butter of, every data scientist. I'll try and not go like a lot of detail into it. I think, it might be just old information for you, but here it's actually one of the most brilliant images that I've seen explaining this concept. So you have like bias and variance, right? And the idea is to get a model that has low bias and low variance. So when you have like model ensembles, two things happen, right? So one is this phenomena of boosting, right? Which is that you have some models that are essentially really good at making some predictions, right? Whereas another model might not be as good as, making that particular prediction, right? So when you combine all of them together, you're basically combining the strengths of all these models. And because of that, you get an accuracy boost, right? So that's reason number one. And what boosting essentially does is boosting essentially takes off the bias, right? Like it basically fixes low bias, right? And, moving towards bagging. So bagging is essentially just averaging out the predictions, right? You take all the models and you take an average vote of that. And what happens then is you're reducing the variance, right? The variance of the model. So that kind of gives you an accuracy boost, right? So that is essentially how these model ensembles help with, decreasing the bias and the variance. And if you think about it, that's exactly what the markets are, right? Markets are just like model ensembles, right? If you take a bunch of people, some of them smart, some of them not so smart, right? Some of them have, are raised in a different way. Some of them have different set of genes. Some of them have different training data or experience, right? And you add them all up together, all of a sudden you have a prediction that's way off, that's way better than an individual, someone individual, right? So that's essentially what the markets do. And this is obviously a concept called collective intelligence, where you see this emerging in different parts, where the intelligence that many individuals bring together collectively is much more than the level of individual of like an individual member. And I think the great example that US developers know about this is open source. Why does open source win? Because of cumulative creativity, right? When you have, like hundreds and thousands of people who are sitting and looking at a code with, again, like different experiences and different intelligences and different, training data, they are able to catch things that Google can't do, right? So things like cybersecurity, etc., like a great example of this, right? Like how collective intelligence has like real consequences, right? And moving ahead, like the other thing that I'd like to talk about is that, markets, people tend to see the markets as something like purely speculative, right? Just a place where people come and like place their bet and hope that, things will work out, right? But really that's not right. The way to look at markets is markets are just, truth seeking systems that work based on error correction, right? So it's not that the price at a particular point of time is right, like you saw in the Twitter saga, but eventually it will reach to the actual value of the price, right? So, this term error correction, I mean, like, I don't know if you guys are familiar with the works of like Karl Popper and David Deutsch. Yeah, so he popularized this idea that, we don't really know absolute truth, right? We just have the best version of it. And till it is falsified one day, that is our best estimate of it. But at the end of the day, it is an estimation. And tomorrow it is bound for correction. Recently, you guys heard that the universe is apparently not 13.4 billion years ago. Like, it's very difficult to stomach, right? Things that you've learned at a very young age might not even be true, right? Maybe there's more to it. And obviously, if you guys are familiar with quantum physics and all that, it just makes you a little more crazy about the nature of our world. So that's the other thing that I'd like to call out, that markets are truth-seeking. And point number 3, markets are the heartbeat of civilization. Like 4 years ago, when I actually encountered the markets for the first time, this was something that deeply affected me, was that it's just one value, the value of price, but really the depth to it is infinite, right? Here you have a chart of, the S&P 500 through time. I know you guys can't read it, but, at every moment there's there's dips and there's spikes, and all of these translate to something that has happened in the world. When Nixon resigned, or when JFK was shot, or, when Trump came in and put on his tariffs, or, Elon Musk tweeted about Doge, right? So it's almost like everything that's happening in the world, there's sort of butterfly effect, right? And really believe me, like for example, if the summer is hot, people will buy more ACs. If people buy more ACs, Whirlpool will be, more costlier. The stock of Whirlpool will be more costlier, right? So there are really this butterfly effect of micro and macro things that actually feed into the market, right? So in fact, this theory is actually known as like efficient market hypothesis. This idea that everything is priced in, right? Like everything that's happening in the world is all amalgamated and coming to this like one number, right? So this is known as the efficient market hypothesis. In fact, there's like an epic joke. Everything is priced in. Don't even ask the question. The answer is yes, it's priced in. Think Amazon will beat the next earnings? That's already priced in. You work at a drive-thru of McD's and you found that the burgers are made of human meat? Priced in. You think insiders don't already know that? The market is all-powerful, all-encompassing being that knows the very inner workings of your subconscious before even you are born. Your very existence was priced in decades ago when the market was valuing S&P Standard Oil's expected future earnings based on population growth. That would lead to your birth, what age you would get a car, how many times you would drive a car every week, how many times you take the bus, train, etc. Anything you can think of has already been priced in, even things you are not thinking of. You have no original thoughts. Your consciousness is just an illusion, a product of the omniscient market. Free will is a myth. The market sees all, knows all, and will be there from the beginning of time until the end of the universe. The market has already priced in the heat death of the universe. So please, before you make a post on WSB asking whether Apple has priced in AirPods 11 sales or whatever, know that it has already been priced in, and don't ask such a dumb fucking question. Sorry for reading all that out, but I just felt it is too epic to not read out.
Can you ask now, or do you?
Yeah, you can go ahead, man. You can ask it.
So if that's the case, why do we have recessions and big financial event if it's already priced in?
Yeah, so
I get the impression that we always do the basic theory. Again, when you say value is the same in what do I say? I mean, in religion versus market, etc. That's very odd in place on the term value, right? Because in that case, I can say something like humans are, what do I say? What's the term you use? Universal, thing doers, for example, right? That's glib, right? I mean, that's not really capturing the essence of what value is, at least in the economic sense, right? And whereas, in the sense that in economics, value is, short term, or rather value of a commodity, if in that sense. Whereas here, values are in the sense that probably there are some other things that we optimize for in various religions, right? And similarly here, I feel that, yes, just to a large degree, what you're saying probably is right. My application is limited with that, I know to say that. But at the same time, it's not, right? It's not perfectly modeled, right? And we can never perfectly model it, right? That's the whole thing about this one. Like everything cannot be priced in. If everything is priced in, then market will always be stable, right? so or rather grow at a very steady state. Couldn't have any of the fluctuation thing. So it's getting priced in over time in an asymptotic sense. Yes, it corrects itself, but not necessarily at any point in time. Isn't that more an accurate statement?
Yeah, I think I think if you had waited for the end of my presentation, I think you would get the answer. But anyway, yeah. So anyway, I think that's why I was very sure to make the argument that it is error correcting, right? And I was also very clear to use the phrase the market tends to the truth and is not the truth, right? Like you said, so if we did have like an absolute value of the stock, the market, like you said, would never move. But that's not the case, right? The information is changing, the risk is changing. So we are getting closer and closer to the truth is the point that I'm trying to make.
Yes.
Yeah. Awesome. So moving ahead. So before we, okay, so right. So let me just go back. I kind of lost my flow of thought. Right. So yeah. So actually, great question at the right time. Actually, so that's the point I was trying to make was that markets are in general efficient. Right. So the question is not the market is absolutely efficient. At every point, it is some god that already knows what's going to happen. That's not the point. The question that you have to answer is, when is the market efficient, right? Because people who know when the market is not efficient are the people who are going to make money. In fact, the people who make the markets efficient are the people who are going to make money. Do you get that? When there is an inefficiency in the market, and for some reason, depending on your nature and your nurture and your training data, if you know that the market is inefficient, you can enter it and you get profit, which is why people do this, right? Which is why people are betting on the truth, right? So if you have some information, you can make the market efficient. And the question to ask is, when is the market efficient, right? So before we get into the science of, or at least my understanding of how to find these inefficiencies, let's just I know many of you probably don't have a lot of experience with the market. So I thought I'll just cover some basics of the market, right? So what you see here is something called the bid-ask, not the spread, but the order book, right? So the price that you see in, say, TradingView, or when you hear that Nifty has gone down 100 points, it's essentially something called as the last traded price. So how it works is there's an exchange. The exchange is getting orders. So when you go and buy a stock, you're not buying the stock immediately. You're sending an order of, say, buying so-and-so stock for 5 rupees, 100 of them. Right. So that goes into the order book, and the exchange, what it does is it basically collates this order book. There are people who want to buy and there are people who want to sell. Right. And when it finds a match is when the buyer and the seller agrees on a price, and immediately there's a spark and there's a transaction that happens. Right. So that is essentially what you have here, this graph over here. So on one side, you have the bids. These are the people who want to buy the stock, and you have the price, and you can see the volume. Right. So you can see that as you get closer to the actual price, you will see that the volumes are dipping. Right. So basically, buyers obviously want more money. Right. So that's why you see more people asking for more money, and the ask is kind of the opposite. Right. So this is essentially how it works. And the reason why I wanted to show this here is how the market works is essentially like a seesaw, right? With the last traded price dead at the center, the fulcrum, right? So depending on where it's heavy, whether it's heavy on the buyer side or the seller side, this basically tips, right? This keeps tipping and moving around. And that is essentially how, the price is established and how the market moves, right? So if you think about it, right, you can see this is a random stock candlesticks, and you can see how the market is sort of moving. And you can see that there is a seesaw effect based on the bid and ask distribution, right? And you can see that, there is some form of error correction already happening here, right? If you assume that this line over here, this is actually the moving average, but for argument's sake, let's just assume that that is the true value of the stock, right? And information is coming, going, people are betting on it. And you can see that this price is actually sort of fluctuating around that, right? So it's there's an error correction that's happening real time, and there's an actual price and people are trying to find it. And, when the market, say, goes over here and this dip over here, right, what happens is people are okay, this stock is undervalued at this point. The market is inefficient. It's time to enter. So they enter. And obviously, when they enter, the bulls come in, the buyers come in, and that raises the price, right? And the price goes up. I hope that's clear, right? When the distribution shifts, the price moves up, right? So that's what's happening. So you can see that there's constant, error correction happening. And how do you look at this? So the question is how do you know that this dip is an error or the actual price? That's what you're trying to figure out, right? That's how you know that the market is inefficient, right? So one way that you could do is you can look at the order book there, and you see the order book, right? You can see on top, that's the asks and below is the bids. And if you see that on the ask side, it's slightly heavier on the ask side, right? So these are people who have already sent their orders to the exchange, and they're saying that, okay, the price is maybe heavily, these people are saying that the price, it's a good price to sell. The market has hit the top. So they're willing to wait. The moment the price hits a certain amount, they're basically going to come in and they're going to sell the stock, right? So just by looking at a snapshot of where the order book is and just looking at whether it's actually bear heavy, seller heavy or buyer heavy, you can make a conclusion. So what will happen is when the price goes up, all these sellers will come into the market, then they will start selling, and the price will go down, right? So just by looking at the order book, you can actually make a conclusion about what the market thinks of the price at this point, right? But the essential point to note is that this is not the entire market. This is only the people who have their orders in the order exchange, right? The entire market is all of the Indians who are looking at the stock market but not actively participating, right? So in an essence, this is only a sample, right? And it's not the population, right? So it's the same case with actually the price as well, right? If you look at the price, how the price has reacted in certain places, certain price levels, like for example here, the price has bounced up. So what does that really mean, right? It is basically also a sample of people who entered the market or got out of the market at this point and essentially telling you what they think of this price over here. So what I'm telling you is that price is also a sample of the population who thinks about something about the price. But the real price is actually in the minds of the population, and that's what we are trying to estimate, right? Not what the sample is thinking, but what the population thinks of the price, right? And so the point that I want to make is that price is part dependent, right? The previous price also tells a lot about what the actual price is going to be in the future. And that's one way to spot the error. And the way you can spot the error is looking at a sample and making an estimation about what the population thinks the right price is, which is a science, right? And there are scientists who do that. And the scientists are here in this very room. What is statistical inference and what is machine learning, if not just that? You take a sample population, you call it the trained data set, you build a model that fits it and hope that it fits the population distribution, right? That's your test sample or sort of a sample. And you can essentially make your conclusions about what the population thinks, right? So that is essentially how you can find errors. And just want to give you more examples of this, right? In specific, I just want to cover this patterns of error, I call it. So what I mean is that depending on how the price is reacting and how the order book is changing, you can make an estimation of whether there's an error in the price with respect to what the general population thinks of the price, right? So here what you have is, again, a price of a random stock. Please focus on that red box. So what you see here is, repeatedly you can see this line that I'm calling support. You can see that repeatedly the price hits here and goes up. Once, again hits here, goes up. Again hits here, goes up. Third time hits here and it goes up, right? So that's very interesting. What does that mean? That means that price is basically like a support level. And when the price comes to there, there are people waiting to buy the stock at that price because they think that the stock is sort of undervalued at that price at least, right? So based on that, you can say, okay, there is likely that there is an error there. And, this is probably a pattern of error. So these are so there is a field called technical analysis. So in technical analysis is exactly what I'm just telling you, is basically looking at these chart patterns and looking at this quantitative data and trying to estimate whether there's an error in the price, right? So this concepts are known as resistance and support. It happens the other way around too. There are also upper bounds for price, where every time the price hits that, people are like, wow, the price is good. Let's get in. Let's sell the stock that I have and let's profit, right? So that's resistance. So if you just take a random chart and please look at these patterns, and you will see that these patterns are there. Obviously in this, it's very clear, but it's not in the real world, it's very clear, because if it is very clear, people will capitalize, right? People will come and make the market efficient. So it's not as simple as this, but this is an obvious example of how things work, right? So this is pattern of error number one. Moving ahead, this is another pattern of error. These are called trend channels. So very fascinating. If you draw like two lines over here, right, and you'll see that the market moves within these two lines. Every time it seems to hit the stop, it comes down, right? So that's very fascinating. And perhaps like it's because people have like an estimation of what the price should be. And they think that right now the price is trending upwards. And as time passes, they get more confidence and they believe that there's a trend that's going and we have to capture that trend, right? So it kind of moves in that channel. And when the price, goes too high, again, there are people who are selling it. So again, error correction happening. Up to a certain point, obviously, like, you could be a wise ass and say, okay, at this point, I'm going to enter because the market is going to go up, but then it comes crashing down. So, but still, that's how, that's another pattern of error. And moving ahead, so this is another, like pattern of error. So these are called candle patterns. So within a candlestick, if you guys know how to read a candlestick, right? So this is like a doji candle. So what you see here is these wicks, right? They indicate the highs and lows in a particular minute or say particular hour. And the body is essentially where the market opens and it closes. I mean, where that candle opens and closes. So depending on that shape also, you can make conclusions, right? For example, if you see this hammer pattern, what you see essentially that happened in that 1 minute or say 1 hour, what has happened is the price has opened here, right? And then it went all the way here. And then the market has rejected it. And it has shot up again. And it has closed here. So this is called as a hammer pattern. And like, it's not very difficult to actually understand this. It's just a clear rejection on the market saying that the price is undervalued below this. So this is actually like a bullish pattern, right? This means that the market is most likely going up. And there are more interesting patterns here. Like you can just combine these candles together and the shapes they form, right? That could also be like indicative of what the market thinks. Like for example, here's a double top. What you see is there's a support here. So people are hitting it once, hitting it twice. And then what happens then is market loses the confidence that, okay, the price is, the stock is overvalued. So it's time to come down and it comes crashing down. So that's another pattern. So that's the point that I'm trying to make, right? These patterns are there all around in the market, right? These patterns of error that I call. And the idea about, predicting the market is perhaps just looking at these errors and like trying to figure out where these errors are and trying to capture that error, right? I like to like liken it to like this example, like this analogy of a blind man in a stadium, right? In a football stadium. So I play a lot of football. So, this analogy is coming from there. So a blind man in the stadium has no clue what's happening. He doesn't know whether this team is winning or losing, right? But what he can do is he can make actual inferences based on how the crowd is reacting, right? If the crowd is, slowly building up in anticipation, he knows that, a goal is going to be scored. The team is advancing towards the goal post. When the goal is scored, the crowd goes wild and he knows that a goal has been scored, right? So at the end of the day, at the end of the game, depending on where the sound is coming, is it the left side, the away side of the stadium or the home side of the stadium, the blind man knows who scored and how much. And at the end of the blind man will be able to tell you what the score of the game was, right? So that's fascinating. So that's kind of how I like to see technical analysis and this looking for errors in the market. There are patterns and signs, and it's just about, trying to figure out, what they are. It was very hard to find a blind man sitting in a stadium because it never really happens in the real world. Sorry. So I just took a random person, I just Googled a person who's sitting with shades in the stadium and I got this guy. So what's interesting is the people behind are also wearing glasses. So actually, I think it is AI generated. I didn't generate it myself. I just found it. And I just want to be clear that this analogy doesn't work if the whole stadium is blind. So it's only one guy who has to be blind. So anyway, yeah. So moving ahead, like, I'm sure that this technical analysis is not something that, that's something that's actually derived from data, right? This is just information that traders who've been trading the markets for many years, out of their experience, they have come up with this theory, right? So, 4 years ago when I encountered the markets and like I got really interested and I was so fascinated by this concept of truth-seeking markets, I realized that, it's very, very possible that there are patterns that exist in the market that we humans haven't even figured out, right? And much like the LLMs of today, when you just get them to predict the next price, soon enough, if you scale them up to internet scale data, soon enough, you start to see them writing poems and code, unbelievable stuff, right? So that's the idea, right? Perhaps if, I as a data scientist could actually, instead of predicting the next word, if I could get the model to predict the next price and try and just scale this up, there'll be this idea of emergence that occurs, right? There'll be probably patterns that we don't even know of. Perhaps like, double dragon, inverted top or something like that. We don't know, right? So that was the idea. And so I also figured that, RL was like obviously getting big, right? It was very clear to me that superhuman AI will only come with RL. Like the agent has to learn from experience and not just learn based on human data, on human label data, right? It has to go out into the real world or into the markets and like try to figure out what's the best way to solve this problem, right? So these two ideas kind of like captured my mind, and that's kind of why I started building Prometei Labs. And the vision here is that AI is the next Warren Buffett, right? In the future, with AGI coming in, all of the data will get like these agents will get really, really good at understanding and finding errors in the market, and perhaps making a great estimation of what the actual value of a stock is, given all the information that we have right now, right? And like AGI is getting really, really good at modeling the world, right? Like it's very, very good, and it'll only get better. And like, my bet is that it's going to get really good at even modeling the world and predicting the market as a consequence of what will happen in the world, right? So I just want to end by this. I'm sure like you guys have you guys seen this movie? It's amazing, by the way. There's a movie on this. It's won a lot of awards. It's actually a beautifully made movie. I'd encourage you to watch it. So in this movie, of course, like Lee Sedol is the Go champion, and he's playing against AlphaGo. And this is like the second game of the match. And he's gone out for a smoke, and obviously, AlphaGo makes like a complete random move, the move number 37, and it's placed one of these, I don't know what these are called, these pebbles, right, on a random place on the board. And all the commentators are like, this is a mistake, right? This is a mistake. There's no way that this could have happened, right? Because it makes no sense. It's not how human beings play, right? And Lee Sedol comes back, and this is the expression on his face. He's completely dumbstruck, right? So it's either like a moment of genius or it's a moment of utter insanity, right? It's done something that makes no sense, right? And turns out that Go has like a network effect. One move here can translate across the board, and that is exactly what happened in this case. At the end of it, this turned out to be a genius move, and that's where the term move 37 comes from. And I had the same expression. And one afternoon I was sitting, and my agents like were trading the market. And I trade primarily options. So options are very risky, and unless the market moves in your direction, even if it stays flat, you will lose a lot of money. So it only makes sense to get into the market when there is actually a movement going to happen. And of course, it doesn't make sense when the market is not volatile. So for some reason, the Indian market's from like 11ish to 1. I don't know, maybe people go for lunch. I don't know what it is, but it's a slumber fest, right? Nothing moves. It's just flat, right? So it was one of those lazy days, and I was just sitting doing my work. All of a sudden, I get an alert that this agent has taken a short position, and like a really, really heavy short position. So I open it up and I look, is this a mistake? What's happening? And I see, okay, it's actually committed. And nothing is happening. It's just flat. And like, I'm, like, my hair started to turn white after I started building this company. The previous two companies are breeze, by the way. So, my hair started to turn white. So I'm just like pulling my hair and like wondering what's happening. Why isn't done this? But my golden rule is don't interrupt the agent, right? Your vision is to build an end-to-end system. So let it do what it wants to do, no matter what the consequences. You lose your money, that's fine. So I wait and I wait and I wait. A few minutes later, the market just, crashes, completely crashes. 100-point drop. It's like a once in a yearly sort of move. It's probably one of the best trades that the agent has ever made in terms of performance. And I was like really dumbstruck. I called my wife and I showed her what happened, and like I was just in cloud heaven. And then I spent the whole day just analyzing the data, looking at volumes, looking at the order book, looking at other stocks, macroeconomic data, trying to figure out why did it make that move. I really don't know. I don't know if it's a move of, like insanity or whether it's a move of genius. But I know it knows something that I don't. So I'll trust it and I'll continue building what I'm building. And that is my move 37 of the markets. So that is what we're trying to build. Thank you so much. I hope you guys, I know it was a long one and very, like, a lot of circles, but I hope you guys had a great time.